a recent kind of innovative structure has been the RATE, the Real Agreement for Tokens and Equity, which is a sale of a security. So you get a certain number of shares in the company, but you get a bonus, and the bonus that's attached to those shares is fixed at a certain rate depending on the time that you're doing the offering. So if you're doing it early and you're doing it under Reg D, then that bonus will be larger. If you're doing it later in time under Reg CF, then that bonus might shrink. So if you're an early investor, you get more tokens. If you're a later investor in more of a public offering, you get less tokens. There's other inventions that are happening, but they all test the limits of securities laws in different ways, and they all come with different risks, pros and cons. So that's something that we can discuss actually as this session goes on. If you have questions about any of those, we can tackle them.
Yeah, and please do ask questions. We're more than happy to answer them. This is supposed to be a discussion, not just speeches by each of us. So if you have any questions about what we're talking about, please reach out. One of the things I think that you should think about in these token offering structures is that tokens are just a thing that evidences a property right or an ownership interest in something. And so, when you're talking about ICOs and coins and Bitcoin, that's very different than what we think of as a token. And so tokens can actually evidence ownership interest or participation rights. You could think of it as, an analogous to like a tracking stock or participation interest in cash flows in a company. So even though you might not have a right as a stockholder in a company, you have a right in one of the particular assets that company owns. There are all sorts of different ways that people are talking about doing this, and I think one of the things that Pratt is going to get into is the economics behind it. But in all cases, when you're doing the legal analysis, you have to think not just about how I'm doing the offering initially, but what does the token represent? What do I have behind it? So if the token is a participation interest, what is the participation interest? What's the legal analysis behind that? And what is the legal analysis behind, if a token represents, for instance, an outcome event? So a token, you can either earn a token because a certain outcome comes in. Is that a derivative? And therefore subject to CFTC regulation. And in all of these cases, when you're making offerings, there are other things like the FTC can observe and look at what you're doing, and to the extent that there's false advertising involved, they may come after you. And the last thing I would talk about, and I think I'd like Josh's view on this, is that just because you don't think that the SEC hasn't come after token offerings that haven't been purely fraudulent, but have said that these are securities. You always have to think that the plaintiff's bar is out there and waiting. And so even if you don't have to you think you're safe from a SEC enforcement action, the plaintiff's bar is going to test that as well, especially if, in many of these cases, these tokens don't work out, and that either the token development doesn't work or the market just isn't there for the token. The volatility in the tokens are such that there's going to be somebody who invests in these things that's going to lose money and will have a cause of action, at least in the fact that there's been a loss. So then they're going to come back and say, hey, this was a token, you didn't register the token as a securities offering, therefore, any investment that I made should be rescinded. Do you want to, kind of talk about what how you have viewed this and how you're discussing this with your clients?
Sure. Each one of these offerings carries the risk that what you're selling to the public is not what you say it is. So if you sell a token, like you said, and it ends up being deemed a security later on, and you've made representations that materially omit key information, you open yourself up to potential class action suit for securities fraud or an enforcement action from the SEC and DOJ for securities fraud. So, yeah, that risk is always there with any of these sales. So you really have to have a good argument, at the very least, that the thing that you're selling to the public is not a security if you're not going to register it as such.
Georgia, at CoinList, how are you all viewing these various offering types?
Well, at CoinList, we take the view that all of these offerings are...
Is your mic on?
I think so.
Okay.
Yep. At CoinList, we take the view that all of these offerings are the offer or sale of a security. So especially at the inception of a lot of these projects when there isn't an actual network built yet, and these are really more in the kind of idea and building stage. It's really hard to argue that these things aren't a security. So I don't even say with like an abundance of caution. I think just with, reality, we deem these to be securities offerings and we treat them as such.
Thank you. And Pratt, you're taking the same view on this?
Yeah, I don't know if
Your
Press the button.
there you
go.
There you go. So, I mean, it is, from the panel earlier this morning, it is a facts and circumstances analysis, but I think you have to step back and ask yourself, what kind of facts and circumstances lead you to the conclusion that you're a security versus not? And I think you have to take a step back to the fundamental idea of tokens is you are tokenizing something, and you have to ask yourself, what is that something? And frequently that something happens to be a business enterprise which lends itself to a securities analysis. And tokenization, just to step back, we're talking about, ways to sell them as securities or ways to, appropriately design them structurally, but it all begins with your tokenomics, which I think the next panel will talk about. From a legal perspective, though, you have to think about what is it that you are tokenizing when you have a business. If you think about, a traditional company, you have an equity class of investors who seed your company with capital. You may leverage that with debt holders. You may do off-balance sheet financing. Every single one of these sources of capital have a set of rights, and there are liabilities that are owed to them. In the event of bankruptcy, there's a distribution of claims that can be made. When you have tokens, you have to think about where in the capital stack does that fall from a corporate finance standpoint, and where are those rights? What are you actually tokenizing? And the curious thing with tokenized projects or token economics is they fuse the identity of your owners with your consumptive users in a way that most businesses don't. They do it in a way that's similar to a cooperative or a mutual or some other sort of, a credit union, for instance, where your users are your actual owners. And so in the token space, it introduces interesting sort of legal issues there that probably don't exist in most general companies. From a design standpoint, one of the things that I think is interesting is when a lot of token projects were created, they were created with this idea of what I would call whole business tokenization. A startup created an idea. They thought about network effects. They thought about how to fuse the identity of the capital providers of tokens as being the consumptive users, and they conceived of an idea whereby the more one would use their token, the more value it would create, and then they would inure the value. Sort of like if you think about a social media platform whereby it becomes more valuable because you use it more, and therefore you should get paid for it. I mean, essentially, it was monetizing that use. But if you think about the way token design could be handled from a corporate finance perspective, there's no necessary requirement that a business be whole tokenized. So you could have a corporation that owns a token project that has adjunct sources of revenue that inure to the equity holders. You could have a corporation with multiple different subsidiaries with multiple different token enterprises. You could have a token enterprise that's leveraged through debt. There are all sorts of token economic designs that lead one to the conclusion of which part of the revenue streams are securities, which part are not securities, which part are traditional debt, credit facilities. And really, it is truly a facts and circumstances analysis that's derived from the token economics. But I think fundamentally, the point we should get to is that most times practical fact patterns for where the birth of tokens came from will lead you down a security path, and you have to live with the implications of that.
Right, and so just to go back, think of it, kind of first, as Pratt was saying, first principles. And, part of what we should go back to is talk about why are you doing the token offering, right? So when we approach this issue, companies are in different places. In many cases, what you're talking about is you haven't designed the token yet, you have an idea, you have a conclusion to where you need to go, but you want to raise capital now so that you can afford the engineers to go and to get the token design.
Yeah, this is George's point, right?
Yeah.
That you were saying that puts you at a much higher risk of your token being deemed a security. And that's not, and you made that business call that you're just drawing that line at CoinList, right?
Right. I mean, so, some people spoke earlier today about Clayton's statement that he's never seen token that wasn't a security. And I think that's a really true statement. The way I like to interpret that is that he hasn't seen a token offering that hasn't been a securities offering, because we haven't reached a maturity in these companies yet where they actually have developed networks where they're using the token in a way that is not like a security, where they're actually using it in a way that is more like a utility, more like an exchange of goods and services on a platform. You know, I mean, it's quite clear to me that the concept of utility token does exist. I have Starbucks points. I've been to Chuck E. Cheese and I've used those tokens. So it's out there. And somewhere along that, paradigm, we've got to find where that line is. And so I think one of the things we're trying to push for is to have some form of safe harbor. And again, we're not asking for new laws to be written. We would just like a little clarification where everyone can be comfortable when this token shifts and crosses that line from being a security to being a utility, and try to get some real clear-cut standards on that. But until that time, I think most everybody is taking the stance that these are securities, these are securities offerings, and you got to find an exemption or register.
Right. And one of the things that we look at is, oh, go ahead. Yeah. Hey, Dan, the people on the web can't hear you, so either we have to get you a mic or I can repeat your question. Yeah. Yeah, no, it's fine. I just wanted to make sure we were clear. So do you want to talk about your conversations?
Sure. I mean, I think that came across.
Oh, I'm sorry. The question is what and I was about to get into this, is if it is a security, if there's your interactions with the regulators, the CFTC or the FTC, generally go along this kind of line. If I know I'm safe, I'm not going to approach them because I don't want to get ask a question that I want to get a bad answer for.
Don't poke the bear.
Right. If I know I'm wrong, but I want to do it anyway, I'm not going to do it because I'm not going to approach the CFTC because, again, I don't want to get bad results. If it's a gray area and I don't feel comfortable proceeding without clarification, that's when you go in and you try to do something like get a no-action letter or at least get some comfort from the SEC. And generally the approach works this way, is you have an initial conversation with the SEC. They will say, fine, we understand your questions. Here's some thoughts that we have, questions that you should answer to us in writing with fulsome legal analysis, and then we'll get back to you. Now, there are ways that you can do this privately. According to SEC releases, they allow private no-action letters so that you can go in and talk to them privately before your discussions become public, and work out exactly what you want to get and whether you think you're in the direction of getting that. So in other areas, we've done that with respect to disclosure. So when we wanted to do covered bonds in the United States and do them registered, we weren't sure whether they were asset-backed securities or debt offerings of banks. And so we went to the SEC and worked on a no-action letter with them to figure out how to do the disclosure. If you're going to do, and we'll talk about the various ways you can do offerings later, that the disclosure of tokens is going to be very unique because it's not a company in many cases. And so you're asking yourself, who's the issuer? What are we disclosing? And what is our reporting?
Yeah, and I just say, we at CoinList, we're in a little bit of a unique position because we're not actually issuers. So we get to approach the regulators in a little more of an informal sort of setting. And we've had a very good relationship. And I think you saw that on the panel this morning, on the regulator panel. They really are wanting to learn and open to understanding how this ecosystem is developing. And so we've had just really good experiences being able to have very frank dialogue without having to go through these more formalized channels where we can, ask questions and posit certain, concepts and ideas. And I think the one thing a lot of people think about these regulators is there's like one person or one group that you go to and that's the information and the source of truth, and if they give you a blessing, then you're good to go. And it's absolutely not that way. There are many tentacles within these agencies, and you have to kind of check off the boxes with each one before you can feel comfortable moving forward in a lot of situations.
Yeah, the potential for crypto is infectious. A regulator may at first be afraid of what the industry is doing and all these shady elements to it. But over enough time, what I've seen at least is regulators have this reaction where they open up and they bloom and they're like, oh, well, this is actually pretty exciting what's happening. There's a lot of potential here. How do we work with the industry to realize that potential? Because otherwise, because the folks who are coming to the SEC are pretty frustrated by the time they get to their doors. So because the laws are not letting them reach that potential that they want, especially in the U.S., so they often go to other markets outside of the U.S. But given enough time and enough exposure, I'm confident and I'm optimistic that regulators will work with the industry to try to make something, or actually find pathways to get tokens into the hands of the public and to have something like a utility token be a real thing, et cetera.
Yeah, and I don't think you can conclude that all tokens will always be securities. We actually are working on no action letters with the SEC right now on certain tokens that we are fairly confident should not be viewed as tokens, as securities. And whether we're going to get any love from the SEC on that point is it's still an open question, and it's not a short process. Because they will bring in not only people from the 33 Act staff, but the 40 Act staff and the 34 Act staff. So they're going to ask, not only is this a security, but is what you're offering an interest in an investment company? Because there are certain analysis where that would actually be an issue. And therefore, again, we're going to go into offerings in 2 seconds here, but the question is you have to go through, just like any securities offering, every single different type of question that you would ask when you're doing an offering of a security, both as if it's just like a corporate security or an asset-backed security, or a tracking stock or something like that. So, Pratt, we started talking about token economics. Was there anything else you wanted to add in that space?
No, I think let's just jump into security types.
Yeah, the security types offering. So, Georgia, you want to cover that?
Sure. So as we've been discussing, in order to conduct a compliant securities offering, you must either find an exemption to the registration rules or register your offering with the SEC. Most people are choosing to find exemptions, and the most popular exemption is Regulation D. It's private placement. Most people are using new 506C, relatively new 506C, which does allow you to do general solicitation as long as you ensure that the investors are accredited. But when you think about that, that seems to be somewhat antithetical to the ethos of tokens and building these ecosystems, to just limit them to 7% of the U.S. population. So, there is a lot of pushback there and a lot of frustration, and I think that's why we've seen a lot of the, non-compliant offerings being conducted. Another exemption that people frequently cite that they are using, and note my phrasing here, is Regulation S. And as most of you guys probably know, Regulation S allows you to conduct offerings to non-U.S. residents. And so it's basically the SEC, saying, we don't have jurisdiction over those people in those offerings, so, go offer to them. What it's not is a rule that says you don't have to comply with the laws of those foreign jurisdictions. And so I think a lot of these, token operators are offering their tokens to foreign residents and saying, well, I'm complying with Reg S. I'm doing a Reg S offering, it's fine. And not thinking about the fact that the UK, the EU, or the rest of the EU, China, a lot of these countries have very strict rules around securities and around tokens, if not flat out bans on these types of instruments. And so I think there may be a reckoning coming in that area as well. Another exemption is Regulation CF. We're seeing that to a minor degree. Again, that's kind of limited because of the size and scope of those offerings, but that is one way to get these tokens in the hands of retail investors. And, Pratt touched on this, but one of the purposes behind these token offerings is to engage your consumer or user or ecosystem member, whatever you want to call these people, and provide something to help them utilize the network and grow the network. And I mean, it's very similar to in the dot-com days when people were trying to give away stock or money or other things to just get people to sign in and start using their networks. And this is just kind of the 2.0 of that to a certain degree. But in order to do that, you need to try to get to your consumers or your users, which most often are what we would call retail investors, just, regular people and not these accredited type of or institutional investors, which are primarily the people that are investing in these, in these rounds that we're hearing about. So another option would be to use Regulation A, which allows you to offer these tokens to retail investors. But again, this is what's called kind of like a mini IPO or a baby IPO, where you do have to do a registration statement on a Form 1A and file it with the SEC. There is a comment period. It's not insignificant. You also have to provide audited financials, ongoing reporting. So it's a significant undertaking. If a company really intends to use this as a financing and raise, up to like the $50 million cap, which Reg A is capped at, it makes sense because, the cost, you can just imagine what the legal fees alone in an offering like that are going to be. But again, that will at least get it in the hands of retail investors. And then, of course, there's the possibility of doing a full-blown IPO, ICO, where you actually file a Form S-1, you go through the full, review process with the SEC. We've seen a couple filed. We have not seen any actually get approval and launch deals. So the other thing to consider, so that's getting you into the hands of consumers and users. Then you need to think about, well, what's the tradability going to be like? What's the secondary market going to look like? How are these people actually going to use their tokens and trade their tokens? And when you're talking about a private placement, Reg D, that has, a 1-year holding period for the most part, pursuant to 144. Reg S has certain holding restrictions, and those securities that are sold to foreign investors cannot flow back into the hands of U.S. investors. So again, how is that going to be policed? Are people doing this? I'm concerned. And then Reg A and obviously an IPO, those would be actually freely tradable at the time of purchase. So again, that's another plus, I guess, for those types of offerings.
One thing to mention here is that when you do a Reg D offering, then you don't have to, that you're exempt from complying with state security offering, so that even if you were to say, okay, I've got my token, it's not a security for federal securities laws, then you have to do a 50-state survey, or at least every state that you're going to offer those securities or those tokens. And so while you may be okay federally, you may not be okay in the state of Vermont or Connecticut. And so, one of the advantages of going to Reg D or A or doing an S1 is the fact that then you are, you don't have to go through and do that same compliance check in each state. Now, there's still blue sky laws that you have to deal with, but the rigor that the effort that you have to go through, if you truly, if you do get exempt from the federal rules, is go through and then have to do a 50-state work through, which is no small lift.
Yeah, and let's be clear, these are web-based offerings, so they will touch every jurisdiction.
Yeah.
I think one of the important points to think about is we've had a supply of these token offerings for that are moving into the security space increasingly. I think as lawyers have thought about this and they've advised clients, the idea of the utility token is waning, the idea of security tokens is increasing, but the ultimate upshot of that is, okay, aside from issuer liability, aside from the process of doing that, what is actually going to happen in terms of the market infrastructure? Where are these going to trade? And, securities, in order to be traded, generally need to be traded on a nationally registered securities exchange, or they can be traded in certain dark pools that are broker-dealers through a broker-dealer network of bulletin boards, or broker-dealers that themselves elect to have alternative trading system status with the SEC. And so, we talked about how in 2007 there were billions of dollars of token offerings, whether they were offered properly as registered securities or not. If we take the position that they are securities generally, there needs to be a market infrastructure in place to absorb this immense amount of supply. And so generally what we see in the market is an increasing amount of interest in entrepreneurs creating broker-dealer ATSs in order to have a secondary market liquidity trading platform. And the process for that is sort of very much alive and before the regulators. There are many, probably dozens of applications right now for off-the-shelf sort of broker-dealer ATSs. The market for selling sort of broker-dealers off the shelf, which is sort of a vibrant market, is now active, and the ability to convert those is very nascent, but picking up. And so we see a lot of sort of market infrastructure issues. And one of the panels later today is about the market infrastructure. So the debate of whether you're a centralized exchange and you need to have all these regulated statuses, or whether you're a decentralized exchange, essentially allowing for OT, over-the-counter type of trades, or whether you're just a bulletin board allowing counterparty matching, is one of the active legal debates right now in terms of market infrastructure.
So we promised to have a discussion, and we've made it a monologue. Does anybody have any questions? You asked about A+. I think A+, it's just larger. I'm sorry, go ahead.
If none of these offerings have been approved as securities, is that correct?
Well, no,
Some are relying on exemptions, and they don't need any formal approval.
So that the people who are now trading these, they're not trading unregistered securities.
So most of the ones that have been conducted under Reg D and been a compliant private placement are still actually in the one-year holding period, so they're not being freely traded. And that's something really important that we should, not forget, is that we're heading toward a cliff where these holding periods are going to wear off, and all of those deals that we saw close in the last quarter of last year and the first quarter of this year are all the trading restrictions are going to roll off, and those people are going to be looking for a place to trade and some form of liquidity.
So some of them might be traded on decentralized exchanges or on very low volume exchanges that are not decentralized but exist in jurisdictions outside the US. So I have seen some of these tokens that shouldn't be traded but are traded.
It's very hard to control. One of the things we haven't had time to talk about is registered tokens, right, or R tokens, because when you have a token, I can put it onto a thumb drive and hand it to you in exchange for money. And here we've had a trade that that's subject to regulation, but hasn't been controlled at all. It's very much like a bearer bond in certain cases, right? Or that's an analogy. So that is an issue, and that's something that has to be dealt with. One of the things that we're focused on is how do we create a proper registered token that can where you have a gatekeeper, so that if you need to keep people that are accredited investors, that's the way you're doing. If they have to be non-U.S. persons, that you've got a gate that does that. You also need a gate for AML and KYC. And there are companies that are being developed right now that will give you keys to unlock people's KYC AML information. I'm sorry, you had a question? Speak up. What I'm saying is that if you do a Reg D offering under 506, I'm sorry, go ahead, Georgie.
Oh, no, sorry. He just asked if it was preempted.
Yeah.
Preempted. Yeah, so the 506, C and D, all 506, preempts state law. So you still have to conduct some state notice filings potentially where you conduct the offerings. You'll have to do a little analysis, but you don't have to comply with those state registration laws. Anti-fraud laws still apply.
Okay. I'm sorry, you go ahead.
Yeah. That is a huge, wonderful question. Yeah, because these are huge deals that go to thousands and thousands and thousands of people. But don't forget, 12G applies to holders of record, equity holders. So the position is that these are tokens or they are agreements for future tokens, which would not be subject.
And one of the arguments also is, even if it is subject, the agreement might vanish before 180 days after the end of the company's end of their fiscal year, because the 12G, the timing of it depends on when the company's fiscal year ends. You can push back your fiscal year up to a certain point too to help you with that timing.
And this also argues for registered tokens. I'm sorry, there's a question over here. Is the question what's going to happen to these guys who are doing the trading? No, they've already been given their warning. The grace period was the warning. If you're, I don't see that the SEC is going to be very friendly to people who should have registered and didn't, especially on the trading side, right?
Yeah, so, we just saw this first wave. It was really more focused on issuer side. And I think we will see another wave that's more focused because that's, that takes chicken, then egg. And so I think that's where we're going to see the next wave. And I think that you're absolutely right that they will be more ruthless with an exchange who's taking money out of every transaction and is considered a gatekeeper and really should know better.
I will say, sort of, this is a very common fact pattern, as you can obviously imagine. So we are working with a lot of whether they're issuer projects, exchange projects, market infrastructure projects that have realized that they got ahead of the law, and now they're trying to think about how they remediate themselves. And so the questions of self-reporting or not self-reporting, self-remediation, doing an analysis and diagnostics of where your liabilities are from a control person standpoint, from a rescission standpoint, from a civil liability standpoint, from a criminal law liability standpoint. It's a very complex question, and it really is idiosyncratic as to what your particular company should be doing in that particular situation. I think, as both Lawton and Georgia said, every day that goes by, there's more and more market clarity, and so every day that goes by that companies sort of ignore these, quite obvious, legal strictures and continue to operate in the gray is probably not good for them. But there are good faith bases to approach a regulator, and in certain instances, when you try to remediate, when you try to show there was no customer harm, it is a path that you might want to consider, but there's certainly no one-fits-all path. It's very, very idiosyncratic and fact-specific.
I think it goes back to the old advice: if you're digging a hole, stop digging. Control person liability is individual liability. It's personal. It's not corporate. And so you need to, our time's up, but it's something that, that these exchanges have to take very seriously. I want to thank everybody for joining us up here, and Brad for getting in.
I want to thank everyone again on that panel for that extremely interesting discussion, and thank you also for questions from the audience. Now, our next panel is about what it's like to invest in ICOs and advise ICO projects. For our panel advising token launches, I'd like to introduce Sushir Varghese. He's the founder and managing partner at Alpha Chain Capital. Richard Lee. He's the founding partner of Global Blockchain Innovative Capital, GBIC. And Graham Friedman, a partner at TLDR Capital, a global advisory firm specializing in tokenization projects and crypto trading. Welcome, guys. This panel will be moderated by Peter Chen. Peter, you got the floor.
Great, thank you very much, Kevin. So the four of us up here, we're all in the same line of business. We're all crypto investors, and we focus a lot on pre-ICO projects. So I founded Building Block Group. We invest primarily in ICOs, and we've done projects such as Zilliqa, TomoChain, and Icon. So we've got Sashir to my left. He's at Alpha Chain Capital. They have extremely good deal flow. I am always regretting the deals that I do not do with them. We also have Richard Lee at GBIC. They have an extremely strong Asia presence, and most of the projects are coming out of Asia these days. And Graham is at TLDR Capital. They have an Asia presence as well, and they also do trading and ICO advisory. So welcome, guys. Just tell us a little bit about yourself. Tell us about your fund, how you got into crypto, and talk a little bit about the strategy that you guys employ to identify opportunities.
Sure, I can start. So I got into crypto through a friend back when it wasn't that cool to be in crypto. And since it wasn't that interesting back then, I ended up selling all my Bitcoin back in 2014 and 15, regretting it years later, obviously. And so after the interest came back in, I started looking into it a little more deeper and got really interested in the idea of decentralization and the immutability and censorship resistance of it. And so that led to diving deeper and starting the Alpha Chain Capital. And so we primarily try to invest in support projects, and we're actually a firm believer that a lot of the infrastructure and foundational technology is still lacking, and we're still in the early to mid-90s equivalent of the internet. And so for us, we are early supporters and contributors of helping infrastructure projects and platforms that will power this next layer of the internet that's being built.
Hi, so I'm Richard. I'm a founding partner at Global Blockchain Innovative Capital, GBIC. So I got into crypto in early 2017. I was originally in private equity and quit my job to start a algorithmic trading fund in cryptocurrency with several of my classmates. Eventually, we were doing a lot of arbitrage and market making among the Asian and US exchanges. And then we started getting more and more into the crypto space. So we started doing ICO investing and early stage investing in blockchain projects. Right now, we have offices in New York, in Shanghai, and also Seoul. So for our investment strategy, we're a multi-strategy crypto fund. So we have a ICO and ICO investment arm, a algorithmic trading and high-frequency trading arm, and also a index and asset management arm. We believe that the markets are still very, very early, hyper volatile. So there's not exactly one strategy that is the most optimal. So we mix a balance of short-term and long-term strategies in our investment arm.
Hello, I'm Graham, one of the founding members of TLDR Capital. Thank you for having me. It's exciting to be here. My origin story, I'm probably a little different here. I came from the arts. I did the past decade, worked as a commercial cinematographer under VaynerMedia, Gary Vaynerchuk's production company. Very fun kind of job, but on the side in 2010 discovered Satoshi's white paper. So this is, I think we're all pretty early on in this scene, the people that become or fill this advisory role. So for me, it was pretty much an enlightening experience to just sort of bobble around the internet, find this new concept on how we can sort of democratize value. You know, in my point of view, the way packets of information bouncing back and forth have changed our culture in the past decade. For example, that first image of the Pope in 2003 with a large crowd, and then in 2013, everybody's got a cell phone up in front of them. You know, the way the information age has changed us, what is that going to do when we attach value to these data packets? So that started to get me thinking. I've always been sort of a futurist. When cars are automated, how do we pass each other? I started thinking we will have contracts with each other. We will get to a certain détente at which we engage in, I will cut you a little bit if you'll let me go in front. And that was sort of what brought me down a rabbit hole. I actually think one of the interesting things, so much of the conversation that just happened was how do we deal with people and the financial ecosystem. I'm really excited for when this digital money is for digital players. So one of my favorite quotes I saw on Twitter is, this will get really exciting when your toaster is trading digital futures with your fridge. I think that's fascinating. I don't know what exactly the world's going to look like when we're all performing 1,000 different transactions every second. Pretty much everybody in this room probably has a cell phone in their pocket that's pinging the Wi-Fi, asking and exchanging information. What's that going to look like when we add value to that? So I come from a very excited place where I think this is actually a revolution in our financial ethos. We're still approaching it very much as in, I hear a lot, well, I really like my Visa. What's the problem there? I think a crypto person will tell you there's many security issues with Visa and data privacy, all that jazz. But to me, this is a much bigger experience. I think we're only starting to click on what the hell this is even capable of doing, let alone getting to the point where the foundation is strong enough that the imaginations can run wild. So that's sort of how I segued in. TLDR, I co-founded with a couple friends last year. We just turned 1 in May, so that's always very thrilling. Began as a fund, multi-strat, buy and hold, active day trading, pretty much just experiencing the investing side of the space. After you make a couple deals and start talking to these ICOs, you say, hey man, you're making the same problem that this person just made. Have you looked at this? You start to realize, especially in the beginning, the communication breakdown wasn't so, or it was quite a breakdown, and people participating in a launch may not have seen any other launches go on in the space. So from there, we've moved to advisory, and since then, I think we all enjoyed the great summer of 2017, which has launched probably, I think, most of our companies into, transitioned from hobby to fierce reality. And now we have expanded. We have brought on more active traders covering across the entire globe. The team is decentralized across pretty much every time zone. So we even brought on recently a new COO to try to help us figure out how to run a decentralized business, which is, I think, something that we're seeing more of. How do you communicate via, text, Slack, Gmail? How do you run an organization very well when nobody's in the same room? That kind of thing. So that's been utterly thrilling. And our latest offering is that we have been collecting cybersecurity specialists, and we're trying to secure the space so that it can be comfortable and transactable.
All right, thank you for the intros. So there's a lot of skepticism about ICOs and pre-ICO projects, and we've even heard that from some of the earlier panels. But there's also a lot of opportunity. I think a lot of the projects that we've invested in together, I think there's a lot of overlap. They've done a solid 20, 50x. Can you just tell us a little bit about maybe the top 1 or 2 projects that you really liked that you invested in?
Yeah, sure. One of the projects that last year we kind of got involved in at an early stage was a project called Aeon. And so what they're trying to do and build is basically create an interoperability between these separate blockchains. And kind of right now, we're at the level of the industry where there's a lot of intranets, and they're all siloed. And if you can imagine that equivalent to like a lot of different websites, but none of these websites can communicate with each other. There's no data flow, there's no kind of currency between them, these tokens can't talk to each other, there's no value transfer or data transfer. And so what Aeon is building is a bridging protocol, and equivalent to that would be kind of the TCP IP of the internet. That's projects like that are really interesting to us just because we understand that the kind of the level, how early we are in what we're building, and the kind of the problems that exist in this kind of infrastructure and the industry. Another project that we kind of really are interested in recently is a project called Loom. And Loom, what they're doing is kind of tackling another kind of a scaling issue. And I think later in the discussion we'll talk about the kind of the trilemma: scaling, security, and decentralization. And so scaling in a blockchain is kind of it's a hard thing to tackle just because when you scale something, you lose a lot of security. And in order to kind of keep it decentralized and a large kind of global scale, security has to be sacrificed. And so what Loom is trying to tackle is how do you drive adoption at a global scale without sacrificing things like security? And so projects like that are kind of really interesting to us, and at a kind of infrastructure level again. And things like that are being continually advanced even as we speak.
Yeah, so I think the some of the projects that we're most excited about are addressing the infrastructure level issues that are currently plaguing the blockchain industry. So, for example, Bitcoin can only really do a couple transactions per second. Ethereum, the next most popular cryptocurrency, can only do a couple hundred transactions per second, whereas you have Visa, which does tens of thousands of transactions per second. So, I mean, the blockchain industry is still at a very, very early stage, and there's a couple projects that are addressing this scalability issue with different ideas that are still unproven, but are very, very exciting. So one of them is Thunder Token. So the team is led by several renowned PhDs in this space from the Cornell Computer Science department. And what they're basically doing is addressing the scalability by having a main public blockchain and then also a side chain under it that can do many more transactions per second. So the idea is that most of the network will run on this smaller sidechain, which can do many more transactions, but is less secure than the main chain above it. So if there's any bad actors or disagreements on consensus, then it'll ultimately move up to the main chain, which is a lot slower, but the main chain can verify what the actual consensus will be. So, I mean, that's definitely a project we're very excited about that's addressing a very important problem in blockchain.
Yeah, I think we'll probably all agree that the very technical projects we will geek and nerd out on all day. Again, when you're in the space, if you've ever made a transaction, with a sizable number of value, and you type in that number over and over again and you repeat it, the space is not very usable. It's a little bit scary. And if you've been in here long enough, you've probably lost some tokens or forgotten a password. If you've really been in here long enough, you've experienced a hack, whether it was Mt. Gox. So, even being an extreme bull, it's got a lot of room to grow. So in terms of projects that we love, I'll just throw an example out, was Icon. It was, I think everybody probably enjoyed it if they participated because the returns were so good, but it was a very broad ecosystem in a very regulatorily friendly environment in Korea, South Korea, and they pretty much said that we are going to partner with all sorts of people to create usability. So we can get more technical, but that's sort of the nuts and the bolts of it. We would love to see increased security. We would love to see scalability, transactional speed, all those things. There's many different projects that are trying to tackle this. I think one of the big narratives that we keep seeing right now, too, is, Bitcoin is consuming way too much energy. What the hell's going on? So some people are trying to take what is powering Bitcoin, proof of work, and saying, hey, let's apply it to other things like SETI, the search for alien life. I would say that Bitcoin is not a waste of energy. It's actually, supplying security to one of the most powerful closed networks out there. We're just not really doing much on this network right now. So in that sense, we have a broad base with the tech projects. At this point in time, pretty much any lower cap project coming out of Asia is pretty exciting. especially when they're technical and foundational. I think everybody here probably invests pretty well along those lines. But something I'm excited to see is we have a project called Essentia, and they're essentially putting a user interface on top of this so that you can actually look at it and not be completely intimidated when you go, for example, to a decentralized exchange, which is a really cool concept, right? The algorithm is handling all of these financial transactions. But I've been on there, and I've been biting my nails that, am I doing the right thing? I've traded for years in this ecosystem, and still the user interface is confusing. So until we start getting past these stages, we can't really mature. Yeah.
Great. So I was going to talk about your investment thesis, but it sounds like we're pretty much all agreed on very similar lines. So at Building Block Group, we're big believers in the FAT protocol thesis, and that's a thesis that Union Square Ventures came up with 2 years ago, and it's that most of the value in blockchain is going to accrue to the infrastructure protocol layer and not to the application layer. And all of the projects that you guys have described, they basically fit that thesis. And two themes under that investment thesis are interoperability and scaling without sacrificing decentralization and security. And those are two themes that everyone has touched upon here as well. I heard somebody say Aeon, I heard Icon being mentioned, and we also have another project that's going to speak later this afternoon called Block Collider, and all three of those are tackling the interoperability problem. And some of the other issues, in the second theme of scaling without sacrificing decentralization and security, I heard Thunder Token, and these are all issues that are trying to be addressed by these new ICO projects. So turning away from the investment thesis, which I think we're all agreed upon, we have very similar investment theses. What do you look for when you evaluate an ICO? Because there are thousands of them out there. We have probably dozens of them that we sift through a week. What do you look for in a project that you would want to invest in?
So usually we'll start with the tech and the team. So our backgrounds aren't necessarily in kind of deep diving into code, but we have staff that are strong engineer backgrounds. And so we'll start from there reading the white paper, and usually there'll be like a technical paper separately. And a lot of these teams, a lot of these projects in the space, which you may have heard, they're being called frauds. There's a lot of like outsourcing that the teams aren't actually building what they're saying that they're building. The teams are not necessarily tech savvy, so they outsource it and get built from other countries. And so we try to verify that. We need to know that the team is actually behind what they're building and actually involved on an everyday basis in what they're doing. And so the tech and the team kind of tied together in that sense. And so what we look for in that also sense is, touches on what you said earlier about sacrificing either security, scalability, or decentralization. And what happens most in like regular retail users is they're okay with kind of sacrificing decentralization or scalability or one or the other. And what we're used to is kind of a high throughput, kind of really fast transactions and fast reactions, because we're used to fast internet speeds and regular like website interactions. And so to most users, sacrificing one of those isn't such a big deal. And so understanding that at a kind of building level is important also. To understand what a retail investor's mind and a retail user's mind works is really important. And I don't think we're there yet. That's why we talked about earlier the UI and the UX, like the user interface and the user experience, aren't up to a level where it's comfortable for a regular user to operate on the blockchain right now. And so all these issues are being tackled right now, but it's hard to find where you kind of find that hybrid mentality of a team that can tackle all of these things, but also have the tech savviness to build it the right way. And so the blockchain industry is kind of a funny thing where I think Ari earlier spoke about that there's no experts in the space yet. And in order to be an expert, you have to be kind of a hybrid intelligent person with a kind of tech background, an economics background, a finance background, game theory. There's a lot of these things. So there isn't really like a specific person that's been groomed to be well-versed in this yet. And all these things are coming together as we speak. And so we look for a little more diversity in the teams and the tech.
Yeah, so for our investment thesis in kind of like your ICO and early stage blockchain projects, I'd say the number one thing we look for is team. So I guess your highly like technical projects that are addressing like scalability or interoperability, we really need to see I guess founders that have like a kind of computer science, cryptography background, have done research in this space, and can really understand the technical issues that their project aims to solve. On the other hand, there's lots of projects out there that do not require as much like technical background. So for those types of projects, we look for, I guess, entrepreneurs, founders who have built successful businesses. And from the technical perspective, it's really important to see kind of the roadmap of a project. Some projects can launch much quicker than others. So the ones that have a kind of like 5 to 10 year roadmap, you really have to make sure the tech is solid. Whereas there's some projects that are much quicker and already have business partnerships or are even a reverse ICO. And a reverse ICO is an existing company or startup that is looking to tokenize their platform, their product, or integrate blockchain technology into their existing users. So there's, I guess, we have different angles as far as what type of project we're investing in.
Yeah, so I think due diligence is a fun one. Anyone that comes from traditional DD would probably look at this and laugh. But to be fair, this is the internet, and a lot of this, you're sort of Googling your information. So first and foremost, I would say if a project comes our way is absolutely the concept, because that is like a 2-second kind of thing. I assume everybody on this panel is probably looking at way too many of these offerings. So just core, what is your concept? What does it look like? Again, if it's technical, it's probably going to start getting us excited. Then it's your team. Like you said, if you've already built a business, if we're looking at people that are experienced, how could you say no? I got on a call recently with some kids that had just dropped out of college. They dropped out after their first week of freshman year. So you kind of have to question, are you even a college dropout, right? Like, what's going on here? So team is wildly important, and a lot of times our due diligence will start with going on Facebook and saying, do you have a family? Do you have a life? Do you need to make this work, or can you just run away with our money and like bail on everything, right? Really simple level stuff. If we get past that and the team is respectable, then it actually comes down to, can they sell themselves? So our advisory, I would say a lot of advisory is sort of a mix between ICO for dummies and just a Rolodex, right? We're connecting a lot of people and we're just sort of saying what has worked in the past. So basically, and for the SEC people, we don't do or touch anything related to the sale. That is up to the team, their legal staff, pretty much all of that. So they need to be strong on executing on that front as well. We have learned, the hard way that a team relies too much on you, and that is also not really what we're capable of doing. We're more like a booster shot, right, than a complete cure. So these factors are our main thing. Once we get past that and we have a trusted team with a great product, then we start to poke our friends about code. Is there actually substance to what they're trying to sell? And then beyond that is just like some basic stuff. Have they been arrested? Do they have a criminal record? In this space, you might engage with somebody who seems great and find out they've been arrested for wire fraud, things like that. True story. So there's just, that's pretty much the due diligence process. I think we probably put more energy in the farther we go, but I can tell you right now, we're looking at so many things. If somebody comes up to me and says, I want a creative token solution, I heard a lot of that on Consensus, or at Consensus, you probably have no need for a token if you can't figure it out yourself. So that's like an easy start.
All right, so Graham, you talked about the importance of marketing, and everyone has talked about the importance of the team and the technology. So can Richard and Sashir also discuss the importance of marketing as well as the importance of the terms of the deal, the token economics? Because I often find that there will be great projects that are, have a strong team, have strong technology, but they're raising $100, $200 million, and the potential for opportunity or good returns there is pretty slim. Whereas some of the projects that we really like are ones where the terms are very favorable, where they're raising $10, $20 million, and that's it. And they're a strong team as well. So talk about the importance of the terms of the deal and as well as marketing.
Yeah, so I mean, I can speak to the marketing aspect. So we are a major backer in a advisory and consulting arm called Block 72. And what Block 72 does, I wouldn't call it marketing in this space, I would call it community building. So the reason is that because a lot of these projects are decentralized, they have, there's a very global aspect in this space. So the most important thing is adoption. So, I mean, no matter how good your tech is, you really need users to support your platform project. You need developers to build on it in order for it to be successful. So it's very important for projects to build a strong community base and following, not just in their specific region, but globally in order to be successful in what we see will be the kind of decentralized future. As far as the token metrics of an ICO, yeah, it's very important kind of how much they're raising and what the project is doing with their funds. Because it's not such a regulated industry, there's very little investor protections. So you really place a lot of faith in the teams to act responsibly, to execute on what they promise to deliver, yeah.
Yeah, so I wanted to bring up a point about marketing. I mean, marketing in this kind of industry is really interesting because it's a little different than traditional way, and what drives kind of success in most projects and in most utility token projects is adoption. And so what marketing really means and what Richard touched upon about community building is really important just to kind of be successful in achieving network effects and Metcalfe's law. And so what happens is that a utility token essentially needs to be used. And the reason it's built is to use it on a kind of proprietary platform. In order to do that, you need to have a large community and a user base behind it. And so the marketing there isn't about necessarily brand recognition or a cool logo. It's really about kind of driving users and everyday people to it. And so we talk about kind of building this technology and stuff, but Graham really touched upon briefly about, high level and comfort of use. And so marketing really tends to, drive like larger groups and sort of earlier before the actual release of the platform, even at like a testnet or a mainnet level. But what happens is that the larger kind of the scale of users that the project is building, it tends to be more successful after the token is released and the platform is live.
So Graham touched on the investment process at TLDR, and I want to touch on that with you guys as well. The one thing about investing in pre-ICO projects is that the timeline for these investments is often extremely quick. The number one complaint that projects have raised with me when they're dealing with VCs is that VCs don't move quickly enough. There will be, one project said to me like, we were talking to a VC fund and they said, yeah, we'll have another meeting in 8 days. And to them, that was an eternity. And, for Building Block Group, we made decisions like investing in Tomo Chain within the span of less than a week, and having done thorough due diligence on that project. So talk to us about how you balance, the need for quickness as well as the need to thoroughly diligence these projects that you're putting real money into in kind of an area that's relatively unregulated?
Yeah, I mean, so in order to kind of make that quick decision, I think you need to understand where the technology is in its current state, where it was before and where it's going. And to kind of wrap your head around that really tends to filter out, I would say, 99% of a lot of the deals that come our way. And you're able to see that, adoption at this rate, we've seen similar projects trying to tackle a very similar issue that didn't succeed, and that the kind of the industry or the ecosystem wasn't thriving. And so we're able to filter that out quickly right away. Next level of it is to really see that there's a strong like team behind it that's actually building what they're talking about. And if you're able to kind of get through those first two, you probably filter about 9 out of 10 projects right there. And then that last kind of go will be the actual concept.
Yeah, so I mean, we invest in very little projects compared to the amount of projects that we see. I would say a majority of our investment is through our network of other VCs in crypto or top crypto funds in the US, China, or Korea. As far as how quick we can act, so we don't have any outside investors, so we can move within a day or a couple days for investment decisions. Obviously, the size of the investment and then the path to liquidity affects that decision. So lots of VCs, they're used to investing in startups where it takes at least like 2 to 3 years to see an IPO, and that's their kind of liquidity event and when they can exit. For lots of these ICO projects, the path to liquidity is much shorter. So funds and investors can have the option to exit their investment in a couple months.
All right, I want to open it up to questions. I saw a hand.
Yeah, you're talking about network building, community building, how it's so important to these projects. As advisors, what do you advise these projects to do to help drive them?
So for people on the live stream, the question is, as advisors, how do you help projects build communities so that there is a community around the token and it's being used?
Yeah, so for us, we try to tackle it by region, and there are certain regions that are more conducive to adopting and familiar and comfortable with cryptocurrency or blockchain projects. And so we start out kind of in those larger regions like Korea, China, Singapore, and then even in the US, it's starting to be. And so starting with those, doing kind of community building at a real kind of person level, holding meetups, speaking at conferences, doing roadshows. A lot of it's pretty similar in terms of like a traditional kind of roadshow, I'd say, or a startup. It's a lot of like boots on the ground, kind of getting out there and talking to people. And then also another thing that helps that Richard touched upon, a lot of people when they invest, they look at kind of like the name brand logos and partnerships on the website, right? It's a little kind of like, a little shallow in terms of investment process, but you get kind of a validity and a confirmation that there's, quote unquote, smart money behind it, or people that did their due diligence. And so we help projects start to work with other funds that we know to be reputable, and kind of give it validation on that level. So.
I'll chime in here. I actually didn't get to comment on the marketing part earlier, but I love it. It's my background. I actually think it's one of the coolest parts of these raises is that they have this massive social side to them. And the things that you can leverage these communities for are pretty amazing. You can pretty much avoid hiring new job positions by saying, I'm creating my new money supply. Let me give you a little bit if you, in return, translate my white paper, make all of my visual content, et cetera, et cetera. So when building these communities, I guess I'll talk mostly about Telegram numbers right now. That's obviously a huge application that's at the core of crypto. How it got there and has sustained itself is a whole nother topic. But when we first look at an ICO, right, a perspective, you go there, you see how many people are in the Telegram. What does the attraction look like? So there are pay-to-play ways to fill that pretty quickly. If you do that, if you're dishing out some money to get people in, you'll get the numbers, but they probably won't be very valuable in terms of organic user base. So once you get that, you start at least using those numbers to sort of massage, put out content pieces. You can put them out on different time zones to see who's responding the best, where in the world is your message receiving and coming back, and sort of go from there. And the goals are really to increase your Telegram number pre-ICO to a comfortable place full of actually engaged users, to which you actually, you need a community manager. You need to keep them happy and answered. And once you have that, and you can really build them out, you try to convert them to become investors. Once you've kind of received your investment on the ICO, you're mostly about inflating that number any way, shape, or form so that you can then go to an exchange and say, like, look at all this liquidity I can bring. You list my token, all these people will trade. So those are pretty much like, that's the arc. And throughout the ICO, you kind of want different numbers at different points.
And I'm sure Graham, Shashir, and I can definitely say that we do not support celebrity endorsements or paid ads that are typical in, I guess, the marketing space. So that's why I like to really frame it as community building rather than marketing.
Okay, that's all the time we have. Thank you to all the panelists.
Thanks again to all the panelists there. Now, our next two sessions are going to be structured a bit differently from these previous panels. We're going to have two founders introduce their blockchain projects to you in the form of Q&As. And for our first discussion, let me introduce Bryce Wiener. He'll be speaking about his two projects, Alt Market and Tau Network. Let me also introduce to you Carlos Roa, CEO of Deus Ex Machina Capital. Carlos will help facilitate this conversation. Gentlemen.
Thank you. Right. Hi, everyone. I'm Carlos Roa, CEO of Deus Ex Machina Capital, and I don't matter here. All I do is find a good coin, research it, say, all right, buy a bunch, close my laptop. It's been a good day, I'll have a beer. That's all I do. Now, the man of the hour here is Bryce Wiener. Now, for those of you who don't know, Bryce has been active in the space since 2013. Yep. He's been called many things: amiable rogue, scammer, genius, and the forefather of Bitcoin Cash. I kid you not, before the Bitcoin Cash hard fork, he went to RBTC on Reddit and posted, I quote, "My name is Bryce Wiener and I want to hard fork Bitcoin." So, Bryce, in your words, who are you?
Well, thank you for that introduction. That was a bit more than I would have asked for. I don't speak in public very much. My background is I've been in technology since my early 20s. You can tell I'm a little gray in the beard compared to most folks in this industry. I'm one of the few that are over 40. And I've worked for Thomson Reuters, Lockheed Martin, two of the largest companies in the world. I've worked for small businesses and medium-sized firms, pretty much the entire gambit. Like most folks, discovered Bitcoin, and I actually operated a rather large mining farm in 2013. I had a 10 terahash mining farm, which nowadays that's less that you can fit that on this desk. However, back in those days, I rented a small warehouse in order to mine Bitcoin. In 2013, I launched my own first cryptocurrency, and I have launched hundreds of cryptocurrencies. Not securities, not tokens, cryptocurrencies. These are independently operating blockchains, fully formed from the first moment they are launched. In all of this time, I've only ever done one ICO.
Just one?
Just one.
That's Tau?
That's the current network I have now. And the only reason I did an ICO was ICOs, I could go on to this for like an hour about this. However, there is an actual reason, a technological and economic reason to do ICOs based on the kind of technology that you implement in your network. Proof of work mining, for instance, what Bitcoin uses, monetizes the network before it's traded. So when you launch a cryptocurrency and miners come and mine, they are expending electricity. They, quite frankly, could be mining someone else's coin instead of yours. So that speculative process begins with the act of crypto mining. If you remove proof of work mining, and for instance, in my network Tau, we use proof of stake, you have to replace that initial monetization incentive as well as create an initial distribution. So in this sense, an ICO is actually the perfect example. However, we did things a little differently than most folks. We ran our ICO for 30 days. We did limited advertising, and we actually capped the ICO at $100,000.
Why 100,000?
Two reasons. Number one, that wasn't really necessary to monetize any larger than that. It wasn't a corporate cash grab or capital formation or anything along those lines. And number two, that is the line for the Jobs Act. So when you go over, $100,000, then you start to catch the interest of the SEC. And quite frankly, a cryptocurrency is not a security. In fact, thank you, Chairman Clayton, for finally saying that. When he says Bitcoin is not a security, the next question we can ask is why? And what is it about Bitcoin that's unique compared to these other networks? Myself, other cryptocurrency developers in the space, there's probably about 100 of us total worldwide that actually create and launch cryptocurrencies. And we all know what those differences are. We've known them for years. That's why none of us is in jail. We don't monetize our networks for personal wealth or personal gain. You might see a couple cryptocurrency devs walking around with $800,000 watches. That might be a security.
Right. So let's start with Tau, or let's start with the music industry, since that's where Tau is centered.
Sure.
So there are a bunch of music/blockchain projects out there, but most of them are iffy in some sense. For example, if you issue a token saying, I'm going to use the token to help you share royalties, well, that might be sharing revenue, and our friends, the SEC, might have a word with you. Others, projects just don't realize the music industry is just a bunch of very well-entrenched interests who don't have real interest in giving up their hard-won gains to all these new guys, or the industry is more real contracts, less tech. So you seem to have found something with Tau, and what is Tau? What is the plan here for music and blockchain?
One of the things that's really important about the music industry is that it was virtually unregulated for most of the 20th century. So oddly enough, a lot of the things that we're currently dealing with in the cryptocurrency space, the music industry has already dealt with. Things like payola, bunco, the mafia investing in an album only to go and buy 1 million copies to launder money and then dumping the albums in the desert. That sounds like a pump and dump ICO to me. So we've seen a lot of this before. And things like revenue sharing, for instance, of music royalties, very well-defined legal pathways. And when you look at things like the sharing of rights or the tokenization then of those rights, those laws don't go away, and those legal precedents don't disappear either. So when we take a look at what some of these blockchain projects for music are actually attempting to do, what the music industry sees is different than what the crypto industry sees. What the music industry sees is all of the terrible things that they got away from in the last 100 years to make the music industry something that is, actually an industry as opposed to a bunch of mobsters. And I make these jokes because everybody knows it. Like, this is old hat in the music industry, and nobody likes to talk about it because it's not like that anymore, and it's not how it works anymore. But that is the bad old days. And the amount of similarity between the bad old days of the music industry and what I absolutely believe is a crypto bubble is shocking. And when you put on top of it, you know, the experience of also living through the dot-com bubble, which most of my peers in this industry were in, you know, 6th grade, that really puts a perspective on the things that are going on that in my, you know, my perspective is drastically different than most folks.
So Tao specifically does what to get around
So,
this?
so in order to, so, you know, to tie
Save
that
the
back in,
curiosity.
what we've done is, because I come from cryptocurrencies and not securities or smart contracts or any of that craziness, what we've done is created commodities, tradable, branded, licensed tokens. These are tokens that bear the image and likeness of a celebrity.
So like Kanye back in 2014 before the lawyer shut it down.
In fact, the legal precedent for our token is in fact the lawsuit that Kanye West levied against a cryptocurrency network for creating a cryptocurrency that bore his image and likeness without his permission. And a court served them with an injunction that they had to stop, and they most certainly did. So these things can be enforced, and when people say, oh, you can't enforce law on the blockchain, I would beg to differ. My entire business model is derived from it.
Well, you talk about artist-backed coins, but part of me is skeptical, just naturally. Then again, I remember this is the same industry where Dogecoin reached a market cap of $2 billion, and just 2 weeks ago, rare Pepe trading cards, the real thing, one sold for $12,000 2 weeks ago, so.
And we've all heard of CryptoKitties.
Oh God, yes.
And those are what we, you know, in the industry, we refer to things like CryptoKitties as and rare Pepes as non-fungible because they can't, they're unique and they can't actually be used as a currency. So they're non-fungible collectibles. In our sense, we're more like baseball cards or the Franklin Mint, where these are collectible commodities where the peer-to-peer trading is simply more efficient than putting it up on eBay, which is essentially how these things are traded now.
All right, so let's run through the process of how one of these is created. Say I'm a music artist. Where do I go first?
The first thing you have to do is verify, I mean, you know, our intent, we're starting with large celebrities because that's going to be the draw, of course. But the intent is to develop this towards a more Patreon-like system. So looking from that bigger goal, you know, the first step then is to verify that someone is in fact an artist. And this paradigm actually allows us to do things in the name of regulatory compliance that the record industry used to do, like sending out talent scouts and agents to dive bars looking for new talent. Now we actually have to do that in order to do AML KYC validation and to verify that these people are in fact an artist, they are playing in dive bars, and they're just looking to buy some new guitars or whatnot. Now on the larger scale, for a celebrity, the first thing is always a rights assignment. For every celebrity that we represent, and we have a growing number, the first two that we've announced are Digital Underground and ODB, Old Dirty Bastard, from Wu-Tang Clan. And we actually have rights assignment letters for their intellectual property. And we have exclusive use to render their intellectual property within the cryptocurrency space. So to the music industry, these look like T-shirts. It's one more merchandising arm that an artist can now employ in their quiver of revenue streams. There's nothing new under the sun going on here, except for the transmission medium itself is a cryptographic token.
Right, so you get an artist.
So you get an artist, and we get the rights assignment. And from that point forward, it's a matter of we run counterparty on our, you know, XTO Tau is a Bitcoin compatible blockchain. We have a counterparty fork. The technology is very low hanging fruit, nothing complex. Actually, it's been in the wild for years. And we're just simply implementing it for this new purpose. So we create the token. We have a captive network, so not anybody can just create these celebrity tokens. It has to be us.
Legally protected.
Pardon me?
Legally protected.
In order to, that's correct. In order to satisfy the legal protections
it's
involved.
exclusive.
That's correct.
Only you can launch these.
Alt market, that's correct. And we chose the XTO blockchain. Now, of course, there's this question of, is our use of XTO making XTO a security? No, in our lawyers' opinions, and actually we went and talked to the SEC, and we have a continuing dialogue with them. And we were actually in the SEC's offices in DC 2 weeks ago. And the conversations were fantastic, absolutely amazing. In fact, I've sat here this afternoon and listened to some of the other speakers, and boy, oh boy, some of the things that I heard up here today are a little disturbing compared to the things that I actually heard come out of the SEC's mouth. I don't, I wouldn't point fingers. However, I think it's very well to say that there is a curve as far as the dissemination of information, as far as what's important and what isn't. And being able to create these celebrity tokens as commodities, of course, the first hurdle we have to cross is it cannot be a security. So somewhere between FinCEN's definition, and I've been a FinCEN licensed MSB since 2014. So I issued all my virtual currencies as an actual money transmitter. So you have the FinCEN's definitions from 2014, and then you have the SEC coming down this way, squeezing down, and there's this very narrow space where we can see commodities and cryptocurrencies are going to exist. And they don't look and operate anything like securities. They're not launched the same. They're not implemented the same. They're not executed the same. They're not monetized the same.
Right. So you launched the artist coin.
Mm-hmm.
Is there, I've heard you call it an initial artist offering.
An IAO, the initial artist offering. And it is an ICO. We're not trying to fool anybody. But we are attempting to establish, by calling it an IAO, that there is absolutely a different regulatory pathway being employed. And because securities have simply dominated the ICO space, it's really just bad branding for us to use it at this point.
So more initial commodity offerings, is what you're saying.
Absolutely. Initial commodity offerings. I like that.
So this is, I imagine, where alt market enters the picture. So what is alt market?
Okay, so now you have these celebrity branded tokens, and of course you could technically have them traded on any exchange in existence. However, when you look across the space, and of course I was looking at my phone as I was listening to some of the other speakers, and the SEC, CoinDesk just released an article regarding the SEC saying they are underwhelmed by the response from exchanges. And when you think about an artist's brand and their name is the value of their product once they've established themselves. You're not going, Tom Osinski, our IP rights lawyer, you will not authorize some exchange that could potentially run afoul of the SEC to trade essentially your name and likeness. So in order to render these cryptocurrencies on the market, we actually had to build an exchange from scratch, because there were no lawyer would ever sign off, and I'm just going to go ahead and say this, no lawyer would ever sign off to a celebrity-branded cryptocurrency being traded on Bittrex.
Ooh.
They just wouldn't. It is what it is. These are U.S. markets, and there's very few of them, and the liability and the risk was simply too high. They exist in a legal gray area too extreme to be able to handle this level of intellectual property. That being said, we engaged directly with the CFTC and the SEC from the very first, and in an attempt to build that regulatory pathway and further define. I mean, I love every time Chairman Clayton opens his mouth and says the word cryptocurrency, I cheer, because they are not a new asset class. They are a specific kind of asset that is not securitized. And when you think about it, cryptocurrencies are not launched by companies. They're just launched by people, guys like me in our basements, in our garages. And we post them up somewhere, and a bunch of people start to like our idea, and they think we're neat, and that's how the communities form. So when you start to talk about manufacturing communities, that's one of the things where the SEC starts to look at you like, what are you really doing? Because when you start to try and encourage a community, you're literally starting to encourage value to enter that network, and you're essentially marketing. And if you're marketing to unaccredited investors a securitized product, that's a no-no.
Right. So all market, you'll have the artist coins. I assume
Artist
you'll
coins?
have other cryptocurrencies.
A wide range. Alt market is our initial, of course, we're going to be like everybody else. We're going to pursue broker-dealer status and an ATS simply because it's a regulatory umbrella. I mean, that is your safe harbor right there. You become a broker-dealer.
Fiat on-ramp?
Pardon me?
Fiat on-ramp?
Absolutely. In fact, we're even looking at becoming a regulated swap market with the CFTC. However, even the swap rules for the CFTC, when you start to dig in to the actual rules and regulations regarding commodities and futures, they could require a little bit of modification. And what cryptocurrency exchanges may run into, in fact, it's one of the things that we're running into, is if we avail ourselves of the existing regulatory pathways through the CFTC, we actually agree to things that we can never fulfill because cryptocurrencies do not work like gold or pork bellies. For instance, there is no clearinghouse. It's just the exchange. So then suddenly all of the reporting requirements between an FCM and a clearinghouse or a liquidity provider, it's all one-stop shopping. So we're reporting to ourselves. It really makes no sense. And when you break down what that looks like, that actually creates a potential for fraud and abuse if you follow the rules as they're laid out. So we're going to start to work with the CFTC a bit in helping mature some of these regulations. Honestly, I would like to see a new set of exams for cryptocurrency. I've taken the Series 65. I'm on the schedule for the Series 32. I would like to see a cryptocurrency-specific exam. And I think that would, at least for developers, that would add, to prove a developer has a minimum amount of economic and regulatory knowledge, I think is not out of the question. And these exams cost a trivial amount of money.
So to summarize so far everything we've had, you're going to launch a compliant U.S.-based, I assume, consumer-facing exchange.
Oh, absolutely. This is, I mean, we're not going to sell ODB coin to private investors. This is definitely a mass market product.
Fiat on-ramp, and I assume U.S. banking?
Yes. In fact, JP Morgan Chase is our bank.
Despite Jamie Dimon being Jamie Dimon saying all these things about Bitcoin?
Money is money.
Expansion plans abroad, I assume, as well?
Yep. We actually do have an international arm that is incorporated in Malta because Malta is the spot to interface with the EU. I know Switzerland is everybody's big fan because they have the regulations already set. However, I'm kind of a guy that likes to go in somewhere and help them make the regulations. And Malta is one of those areas right now. They do have...
Maltese banking?
Pardon?
Maltese banking?
Bank of Valletta.
Oh, already?
Absolutely.
Binance just announced just yesterday.
We've had it for a month. It's the difference between doing things the right way and needing to make a lot of noise because you're afraid that someone is going to come and shut you down. When you just walk through things, then you don't have to make a big splash because when you turn on the spigot, you can actually advertise to everybody else on the planet. We are absolutely planning on running television ads because we can.
You can do that?
Absolutely. It's a commodity.
For crypto?
Sure. Pork is the other white meat. Everybody's got milk. You can do this with commodities.
Right. So Coinbase 2.0, basically, with your own exclusive coin launches.
As opposed to attached to venture capitalist funds, which create an obvious conflict of interest.
And you're getting a cut of all this through trading fees and the launch as well?
We don't. We actually make a portion off of the IAO. This is for the purposes of implementation of the technology, ongoing brand protection. We actually do get a portion of the proceeds from the initial sale. But our trading fees are simply to prevent wash trading. It's not intended to be punitive or a profit center.
So essentially you have a factory for producing new tokens in limitless supply since it's just music artists, and you have the exchange to trade them on. Mm-hmm. You do realize you have the holy grail of crypto. I mean, this is as
we
close
like
you
to
can get to
we like
a
to think
legal
so.
money printing machine.
I would not say that. Good Lord. It's not in a room full of lawyers, certainly.
True.
Not unless I had you all on retainer. But one of the problems that the SEC has with the space is, in fact, people like me. And that's why I personally wanted to lobby and engage Congress and regulatory bodies directly on behalf of all cryptocurrency developers, even the ones I don't like, because we are the people that create the networks the entire world trades. And if done correctly, this is the American dream reborn. You can literally have entrepreneurs creating cryptocurrency networks in their garages, monetizing them for about as much money as they would get borrowing from friends and family, and setting up a business. Is that a security, or is that the American dream? There's a balance here that needs to be struck. And I think we're getting closer and closer and closer to that balance in a very positive way. I don't see anything that's going on right now in the regulatory space as negative. Not even people going overseas, because quite frankly, if you go overseas to escape U.S. regulations, it is what it is. I mean, you kind of look like you're trying to get away with something. So I'm not one who believes in regulatory arbitrage. If you have a legit, honest product, there should be no problem launching in the United States. In fact, it should become the gold standard for legit, honest products.
One last question before we open up to Q&A. When is All Market launching? Next year? Late this year?
No. It's actually under very much active development right now. Our platform will go live towards the end of July. So
That's very soon.
Oh yeah, we're under 60 days.
All right. Well, opening up to questions. Just one little note. No comments or speeches, just Q&A. I'm sure there's plenty of time for addressing Bryce directly and any grandstanding speeches, so just questions. Anyone? No? Really? Well, oh, over there.
The 721s are, how to put this?
Just to summarize the question for viewers, the question is the difference between
CryptoKitties and what we're doing.
Yeah.
Specifically, our product is a bit more like the original Rare Pepe, where you could create, for instance, one piece of art that had 1,000 issuances. And then the cryptographic scarcity of those 1,000 issuances is what determined the trading afterwards. Whereas with CryptoKitties and the ERC 721s, these are mathematically combinative, mathematically derivative products, I guess you could say, to where you can breed two CryptoKitties together and you get a third one. So that's what that standard is for. Whereas these are more just, I mean, you could literally do this with ERC 20s. Except, of course, for, you'd have to launch your own Ethereum to do it, but you could legally do this with ERC 20s and accomplish the same thing.
All right. Anything else? No? Well, in that case, shall we end a bit early, give the next panel some time?
I'm
All right.
fine with that. Not much for talking. Thank you so much for your time.
Thank you.
Yield back time to the floor.
So gentlemen, you actually yielded time to our audience here as the, so what we're doing next is we're going to take a 10-minute break to stretch our legs. Please feel free to refresh your coffee cups, say hello to anyone around you whom you didn't get to do so at lunch. We'll be back here in 15 minutes at 3:10 sharp. See you then. Ladies and gents, I invite you all to find your seats once again, please. Recorded after? Yes, it is. Yes, it is. So I'm not completely confident on how exactly you'd access it. I know the lady who's sitting back there would have that answer for you. Yes. Folks, we're going to get started on our second Q&A session here. And to start, I'm going to introduce up on stage Patrick Mcconnell. Awesome. Patrick is the co-founder of Block Collider. It's a mineable multi-chain project, and he'll be talking to us about interoperable protocols. Graham Friedman, whom we've already met, will help facilitate this Q&A.
All right.
Gentlemen, take it away.
Oh, thank you. Oh, yes, okay. Can we have a gavel?
No, I'm afraid not. But if you guys get questions, just go ahead and repeat the question.
Oh, yeah, absolutely, absolutely. Okay, let's gather your attention, rally you back here. Nice to see you guys again. I'm here with Patrick, who is from Block Collider, an amazing team, somebody that I actually love to hang out with and chat about crypto in general. And they are one of the nerdy tech projects that we think is actually moving the space forward. So everybody please welcome Patrick. Thank you. Cool. So let's just do an introduction. What is Block Collider?
Block Collider. Well, I guess show of hands, who here at least feels like maybe they a little bit missed the boat on the blockchain thing? Okay. All right. Hey, there's a lot of honesty. It takes some bravery there. What you didn't miss the boat on is something that we are exploring ourselves, but we don't claim to have invented it or even created it, but it's this concept of a multi-chain. And a multi-chain data structure is entirely something that was birthed early last year and is as fundamentally different as a blockchain in its applications as I guess a blockchain was to the financial system and to what we're looking at from an instrument standpoint. It's a new data structure. And this data structure has implications for primarily decentralized exchanges. So it creates an environment that is far more conducive for generating this strange new decentralized exchange situation. And that has enormous regulatory implications, obviously, but it also has fascinating exploration opportunities and technical challenges to overcome.
Cool. So let's talk about decentralized exchanges because we had a good chat. So as I said earlier, I'm extremely excited to see what like a hyper fungible world looks like, right? Where these tokens are popping in and out of your wallet at an amazing clip. This is pretty much the concept of a decentralized exchange, right? Is that an algorithm is handling all of these trades?
I think there's two parts to a decentralized exchange. A, you're absolutely right. There is this is how computers speak to each other. And so what we saw with NASDAQ, there's an element of an evolution of the exchange experience. And NASDAQ piloted a lot of that innovation. But the actual concept of an exchange is changing with a decentralized exchange in what you can trade and how it is traded between machines. And it's a language for exchanging value. It's a language for exchanging data that is suitable for computers. They speak it well. They trade better on a decentralized exchange than they do on a traditional market. It's almost like the traditional exchange was created for a human-type interaction, and a decentralized exchange was created for a computer one. And the second element of a decentralized exchange is this independence category. And that's where I'd say it also needs a lot of help from a definition standpoint, from regulation and from legalese, in that technically with the decentralized exchange, it creates this immutable relationship between both parties. Immutability being, it's not a reversible trade. It's not something you can like pull back and say, okay, that didn't work, or due to regulation, we froze this. A decentralized exchange doesn't actually have a stop button, and that's interesting.
Could you guide us through the current state of these decentralized exchanges?
So everything is in the very formative stages. A lot of the dream is very clear in that it's an extremely desired thing. But right now what we're seeing is a lot of like copies of currencies that were made in the past on a blockchain. And these copies are kind of rebranded as a hurried creation. Like great vision, but the application of it we're going to start seeing over 2019 probably is where you'll start seeing a very strong emergence of these, especially as they directly contend with centralized exchange markets.
And just to put some, I guess, names to them, what are the current major players in the space?
So I'm supposed to like rat on a few, or?
No, I could say Ether Delta is a very big one. There's Switcheo for Neo. So I guess as they exist right now, they're kind of blockchain specific, right?
They're blockchain specific or they're instrument specific. So they'll be tied to a token. And what we just saw was a conversation around the difference between a 721 token and an ERC20 token is one level of difference. But there is a whole order of magnitude in difference when you talk about moving a cryptocurrency from its own native blockchain and ascribing that value to an external blockchain. And that's this true decentralized exchange, is this ability to say, okay, for your Ripple, I will give you X amount of Bitcoin, and do so without any third-party involvement, any centralized character anywhere, and do this in a way that I can, interact with someone without even knowing who they are, which is a fascinating, cryptographic process.
Awesome. I'd love to talk a little bit about Block Collider itself. In much of your content, you refer to it as a loom. This is the analogy you make a lot. Am I correct? All right, cool. Would you mind sort of describing that, how it works, how the different chains interact, and how Block Collider sort of pieces the blocks and collides them together?
So Block Collider, if you zoom out and look at the whole ecosystem, there are a series of blocks being issued. And to me, it's this image of almost smokestacks. You just kind of see these blocks issued from different cryptocurrencies in very siloed computing environments. With the Collider, the objective is to create a multi-chain data structure. So the Collider is the name of the application that runs on a multi-chain. And the multi-chain takes those blocks from each one of the smokestacks and weaves them together. And this is that loom process. In the process of weaving them together, it actually uses traditional mining. So the same, cold, hard way that we've been validating transactions with Bitcoin, which has clearly proven itself over the past 10 years or so. We are also building a multi-chain with the same premise that it's computationally difficult to reverse this work. And so what that all means in the net is after Block Collider is running, which actually launches June 10th at 9 p.m. Eastern, after it is running, you will have a copy of the global crypto ecosystem point in time. And this is a huge step forward in the technical space, but we say that not as some sort of pride thing in that we found something, but that we want other people to explore what they can do with this as well. And that's where we come to venues like this and figure out from a decentralized exchange standpoint, how can we help decentralized exchanges use this technology to enable trades.
And what do you think is the biggest pitfall, though, in the current systems that are up?
They're called validators, and a validator is a rebranded bank. And there's nothing wrong with banks. I hope everyone in here uses them, and probably do. They're fantastic institutions. I came from Citadel before this, which wasn't a bank, but banks were a close part of that relationship. And in each scenario with a banking institution, there's always a path towards evolving the banking process. And what a validator does is, in the crypto sense, it says to you, well, I promise that the other party traded that Ripple or sent you that Ether. And as long as you trust me, the validator, you can also send your trade. And that, to me, is actually a recreation of what I think is an archaic element of the banking system, which is this auditing component and the auditing or the compliance through auditing that's brought from trying to verify that something actually happened when you don't have all the pieces. You know, it's this idea that finance or like SWIFT transactions take days to do, and it's because each entity along the road doesn't actually have all the answers to the problem they've been given. In the crypto case, you have this validating entity, which is the same in a sense. It's a recreation of this broken method, in that the validator just is something you have to blindly trust and hope that that validator did what you were supposed to do. And the premise of a trustless environment is not that there is no trust, but that trust is not needed. And when you can create an environment where trust is not needed, that is a truly safe environment, and therefore a best in class from an environment standpoint.
So if this thing, okay, we know a lot of exchanges, they tend to make their money from taking fees from the trades, right? This is all happening automatically on the back end, right?
Oh, so to give you an example, then an exchange is a validator, right? An exchange said another party did this, they traded that event, and so now you can send your Bitcoin to the opposing party. That would be a validator. And one of the things that validator then does is create these fee models, which currently we're seeing an insane amount of profit being scooped from these innovative projects that have captured a lot of people's both hope and capital. And they are charging these outrageous fees just to kind of participate in the exchange space, where it turns out that a lot of your hope and your capital as an investor in one of these projects is actually just being given in cash form to an exchange, which is not an acceptable way to move forward, at least from an entrepreneurship standpoint.
Yeah, absolutely. I know on the advisory side, we see exchanges as often being pay-to-play barriers or completely based off metrics that are not core to your project, which could be Telegram, things like that. So it's very cool that it could be automated. So I guess in this world that I've envisioned, where these exchanges are trading tokens extremely quickly, what is this going to do for our taxation, right? If we're doing every single trade is a taxable event, right? And we're going to do this all the time, every day. What are your thoughts on this?
So that is a fascinating question. And I think, or I would hope, that someone in this room is going to help clarify that question, because if they can, that would be, that's huge. That's as big as an LLC. How do you tax a decentralized exchange is going to be a huge question for mankind. I think, from the way that we see it playing out right now, and this is like, I think it's a lot like an amusement park, and that you're going to be taxed on the entry, but you're not going to be taxed per ride. So it's like, while you're trading in a decentralized environment, the doorway in and out is going to be the gateway where it's most efficient for regulatory authorities to receive some sort of tax protection or receive some sort of tax liability. But on a per trade basis, the problem is it's a decentralized exchange that is true. A decentralized exchange that uses like this multi-chain data structure, it's a math function. So from like a securitization or from the protection of the instrument, the math proof either executed correctly or it didn't. There isn't the same this or that or counterparty risk or opposing event in like the collapse of an exchange or even like front running. It's whether or not your math function ran. So it creates this opportunity to craft from a tax perspective what the best way forward is, both protecting individuals who are using these, but also encouraging what is a fascinating innovation opportunity.
Cool. Very quickly, as we're running out of time, are there any questions?
I'm just trying to get a handle on it. So is it
Can we repeat the question?
So the question was, can an individual create an algorithm? Is the environment that we're speaking of a place where someone could just create an algorithm and then let it go? The answer is yes. They could create a method to conduct trades that operated of its own accord. That model in this situation would be probably not very lucrative or difficult to do lucratively. But in many situations, that would be possible, yeah. Interesting question. If you have a magic algorithm like that, we're interested.
well, right, this is, like the bad side and the good side.
Of course.
High-frequency trading and then the long-term capital management.
I'm not necessarily opposed to high-frequency trading in that I still think I would consider it like rapidly efficient value, in a sense, and accelerated access to liquidity. However, you're right, there are situations where you could create markets for levels of participants, which I think right now we don't see. You're either in or you're out. But in a decentralized exchange, because you can design an application that is the ecosystem or the math behind the actual exchange itself, you can create situations where, like IDX, which slows down trades using something they call the Thor's hammer. I don't know if people have read the Flash Boys book, or it might be IEX. But this exchange is entirely unnecessary. They basically send your trade through a coil, and that it just rounds about in the coil for like 10 minutes, and that way they're like, look, no high-frequency trading. It's like, well, that's actually inefficient trading, but you could create an application in a decentralized exchange where it's like, look, if you're going to trade something in here, it's going to take you 10 minutes to clear it. And so it creates an environment where certain instruments could be constructed around applications that are literally not possible in today's markets.
Super cool. Any other questions? Awesome. Could you leave us with maybe a vision of what the future will look like when this takes off and you have other community built around it?
Future's bright, of course. Happy. Everyone's happy in it. The future of Block Collider is a ecosystem of cryptocurrencies that are no longer at odds with each other or in comparison with each other, but in fluid partnership with each other. And the original name, the Large Hadron Collider, which was the project that this was named for, or named from, started as a coalition of scientists post the atomic efforts in the Manhattan Project, in saying that we can discover new ways that particles can be combined, and we can lead those discoveries with innovations in physics and innovations in science. The Block Collider is the same philosophy. Let's bring together cryptocurrencies in a totally agnostic to any nation, agnostic to any chain, and explore these features and these functionalities in a method that still retains the original promise of the ecosystem. So no trust, in a sense, where you can build an application that consumes Ethereum and an application that consumes Zcash and explore each one of these and allow these ecosystems to evolve. And so then at a day-to-day basis, the future is much more efficient, but the future is a lot more free in a sense that you, as a human being, have a lot of barriers to enter the current stock market, and especially to do so in a profitable and productive way economically. But in the future, these decentralized exchanges will enable flawless, seamless integration with value attribution that could be a day-to-day event. Where right now you see things like Kickstarter, which allows you to put a vote towards an innovation of a product. You'll be able to do that with a lot more strength and a lot more confidence, so that even early adopters of great projects will be involved in the great project's success because they took the risks and because they worked on it. And so what you're going to end up seeing is that decentralized exchanges in the future is actually the evolved form of Kickstarter. So we're seeing an even better way to ascribe value to excellent, best-in-class projects and reallocate value where it's been inappropriately allocated in a fluid manner, e.g. situations where Uber may be causing conflict and yet all of their C-class, D-class, E-class investors are trapped within this large behemoth-sized capital fund. And that is also inefficient. So we'll see on both sides of the pendulum a better, brighter world.
Perfect. And my thoughts are maybe we'll stop paying attention to all this token stuff, right? It'll be sub-layer. All right, that's all the time we got. We'd be happy to chat with you guys in person afterwards. Thank you.
Very insightful, gentlemen. Thank you. Now, as we arrive at the final event of the summit, I invite you to make sure that you're connected with the people that you met today, be it LinkedIn, business cards, napkins, whatever your speed. Let me bring on stage our panelists for tokenization, or tokenizing financial markets. I'd like to invite Michael Ovid. Michael is the co-founder of AirSwap, a peer-to-peer token trading platform for ERC20 tokens on the Ethereum blockchain, and a veteran algorithm trader. Jor Law is the co-founder of Verify Investor, a leading resource for verifying accredited investor status. And Gerald David, COO at EverMarkets, a platform for on-chain derivatives trading. Carlos Roa, you've already met him. He'll be moderating this panel.
Hello again. Test. There we go. Right. Hello again. That was a short pause. Now, before we begin, I just want to give a further chance for the single panelists to introduce themselves and what their businesses are. So, let's start with Gerald.
Great. Thank you. It's great to be here. Great to be with you today. My name is Jerry David, and I'm the CEO at a company called EverMarkets. EverMarkets is an exchange that's really a hybrid. We're talking a little bit about centralization and decentralization today. It's a hybrid exchange whereby we offer off-chain matching, whereby we do a clearing and settlement on the chain as well. We're going to be trading traditional commodities as well as cryptocurrencies, and we'll be utilizing our own token as the means of economic transfer at the exchange.
Hi, I'm Michael Ovid. Previously was a high-frequency trader at Virtu Financial. Actually got into that before the word high-frequency trader was popularized by the media, popularized and demonized at one point. That was a really interesting revolution where we're touching all sorts of financial markets around the world. That is what I did for the majority of my 20s, and now participating in another financial revolution, which will touch all parts of society, including law. At AirSwap, we're basically building what is a decentralized trading platform. So a decentralized trading platform is not really an exchange, not really, doesn't take custody, just allows people to search and discover tokens, allows people to find each other and trade peer-to-peer.
My name is Jor Law. I kind of wear multiple hats in the industry. I am on the board of Prime Trust, which does escrow and custodial services in this space. I founded a company called Verify Investor, which does accredited investor verifications. It's now a T0 subsidiary, and I've been very active in the the space to tokenize securities, having advised companies like Polymath, and then working closely with other folks like Harbor to kind of integrate Verify Investor into them.
All right, so I say let's start with the basics. Everyone's pretty excited about tokenized assets and everything trading on the blockchain, but let's briefly review what are some of the benefits that come with having things on the blockchain instead of normal exchange or what exists right now. I, for one, I'm aware of this because I love this anecdote. You can use it to reduce administrative costs and ownership reconciliation. So as a little example, in 2015, a court order asked Dole Foods to give a payment to its shareholders. So there are around 36 million shares outstanding, but there were payments filed for 49 million shares. Yeah, the math didn't add up there. So with a blockchain, this could be eliminated. So I just want to ask the panelists, what are some of the benefits you can achieve with a blockchain compared to what we don't have?
Totally. Yeah. So, the way that we look at the world, we look at kind of futures exchanges as means of economic transfer, as I said before. And the neat thing about the blockchain is it allows us to streamline the process. So my background's been in building exchanges. I've worked at some of the leading exchanges in the world. I worked at CME, NYMEX. I've built 2 exchanges, lived overseas to do it. And the neat thing about what we can do here is we can take a look at kind of clearing and settlement component, and we can dissect it. So when you take a look at clearing and settlement, which oftentimes is quite cumbersome and quite burdensome and very, very time-consuming, it involves many, many different players. It involves a trader who's got a relationship with a clearing member. It involves a clearinghouse and exchange. And the process of flow of both money and risk is quite lengthy, and it's also quite time-consuming. So we can take a trade that otherwise would take, a day and a half to clear and settle, and we can do that in a matter of minutes or a matter of seconds. So when you think about risk, that really is helpful to the entire system and eliminates a tremendous amount of systemic risk. So, if you think about a customer position, and if you're trading, you've got intraday trading risk, obviously. What if you were able to use the blockchain through a smart contract to make a real-time margin call, whereby somebody was prohibited from entering into another position, or even more so, what if a position was forced liquidated because they didn't have the wherewithal or the commodity itself was too volatile for them to be holding that position? So when we start looking at things like that and really just boring down on what the efficiencies are, we find that there are just so many, and they're all customer protections, they're more efficient marketplaces, and even cost reductions, as you mentioned a second ago.
Right.
Yeah, and I think that's totally right. And I think to just expand on that further, we talk about 2017 being like the year of the ICO, where there were all these different projects around the world that were basically able to create and sell assets. And so if you just think about it at a very fundamental level, what Ethereum did, what ERC20 tokens did, is it allowed us to define a way to create and sell an asset very easily, right? So if you think about all the lawyers in this room, how difficult is it to actually create an asset and sell it to someone with trust, right? Why do lawyers exist? Is to ensure trust between 2 parties. And if you think about it in the ERC20 standard, what that allowed is for people to automate that entire process. So for the first time in human history, what we have are these assets that anyone in the world can create, and they can sell it to someone else in the world with the click of a button, right? This did have profound impacts on capital raising in 2017. But if you just take a step back and you think about how many people there are in the world and how many people are actually participating in these markets, if you have 20,000 people around the world that are willing to purchase your products for $1,000, you have a $20 million raise. So take that 20,000 people and make that 200,000 people, or make that 2 million people. You can start to think about this technology is only at the very, very, very early stages, and how much bigger it can actually get. I think it's going to have profound impacts and be massive.
Yeah, I think for established markets, they operate fairly well, but they're only accessible by, larger companies, right? So, blockchain technology could promise, maybe lower fees, better efficiency, better transparency. But where I think it's immediately useful is for the private capital markets, where really right now there's insufficient tracking and there's no liquidity. So this new space that we're all kind of embarking on is giving the underrepresented companies a way to the market. I think that's more efficient and superior to anything that's out there now.
Right. So one of the neat things, as mentioned here, about blockchain is that we can tokenize and grant liquidity to assets that were formerly a bit more liquid, such as, let's say, real estate. So Michael's office is based in Brooklyn, right?
Yeah, we're in Brooklyn and Hong Kong.
So I'm hearing that Brooklyn has a hot, real estate market, and I want to buy in there, but I don't want to buy a specific building. That's just pain. So I'm thinking, and someone here, correct me if I'm wrong, would it be possible to, say, tokenize a basket of buildings and trade that over the blockchain?
Yeah, so I think people have been trying to, I think there's a few ton of different ways you can go about doing this, but I think for years people have been trying to create a stock market for real estate, essentially. Obviously, it has to be subject to securities laws and be compliant, of course. But why hasn't that happened before? When you look at any new technology, you have to ask yourself, what can this do now that wasn't possible before? So people have been trying to create stock market real estates. The reason they can't do it is because it's not scalable, right? Actually creating this asset and having people come in and being able to transfer it, this is all, there's so much paperwork involved, there's so much back office involved that it's not really worth it. But essentially with blockchain, with tokens, you're automating the entire back office process. And obviously, again, subject to the correct regulatory regime, this is now possible, and I think we'll start to see this over the next 2 to 5 years. I think we'll start, for the first time in history, seeing real estate, stock markets, art stock markets, pretty much anything that you can fractionalize and assign a value to it, I think will be tokenized and trade.
I think you've always been able to do that, right? You've always kind of been able to, if you were a Brooklyn building and you were looking for investors, you probably raised some money. It probably was fractionalized. You probably got a handful of investors. A few years ago, you were able to get more investors because you took advantage of crowdfunding rules. The same rules, by the way, that apply to blockchain, right, and tokens. So it's not that token technology suddenly makes you able to do these things that you couldn't do before. I think there's two things. I think the technology is superior. It allows you better tracking, better tools for liquidity that are more efficient. So that's number one. But the other thing, I think, is that in the blockchain space, you had a prolonged period of basically illegal issuances and illegal trading and things like that. And that happened long enough that you had a critical mass of investors that were already doing this, right? So when you talk about tokens, people are interested in trading them, and suddenly you can bring liquidity that wouldn't otherwise have been there to another space where the same investor might have been interested, but they hadn't seen that liquidity. So now when you marry crowdfunding, which has existed for a while but has limited liquidity, with tokenized technology, which is still emerging but has liquidity in the marketplace, and they both find a way to work together in a harmonized regulatory compliant manner, then I think you've got all the pieces that work together. It couldn't have happened, I think, without this last 2 years of questionable activity in this space.
Cool. Yeah, I mean, Carlos, I think what you're talking about is really almost the holy grail of a marketplace, right? It's being able to custom create a contract, or even better, have users custom create a contract. And that's something that, in our early days of our white paper, probably up to version 40 or 50, was really a staple part of what we're trying to do. What we found out is that in practice, it's a lot more difficult. We would very much like to have an open marketplace whereby anybody could create a contract that then goes to the marketplace for liquid trading. But we've been cautioned on that approach, primarily because, not because you can have too many contracts that are out there, but it's quite possible that you could have a contract that someone could create that might unfortunately introduce systemic risk into the system. So what if somebody introduces a contract that has a delivery mechanism that's faulty? Or what if somebody introduces a contract that is susceptible to market squeezing or allowing bad market participants that are in there? So, our approach initially, as we've taken that out, at least from our business, is to kind of work around more standardized instruments with the goal and the hope and the aspiration to work with the community to later on be able to list contracts that are created in unison by the folks and the users that are out there.
Right. So that comes the not so nice part. What are some of the challenges that we in the whole space faces going forward with this technology and tokenizing more assets to put on the marketplace? I mean, there's technical, such as Ethereum has, I think it's 15 transactions per second around. So, and Michael, when you were at Virtu, how many transactions were you doing per second with HFT?
Orders or trades?
Let's go with trades.
Depends on what market, what strategy, but a lot more than 15 per second.
Yeah. Then we have other things like governance. For example, if we were tokenizing some stock shares, then we can introduce into the contract such as tenured voting. So the longer you hold shares, in this case security tokens, the more votes you have. So but you start asking, well, how much does this mesh with existing legal rules? So I'm generally asking an open-ended question. What do you see as the biggest challenge going forward? Start or?
Yeah, I've been giving this a lot of thought because, I've been so front and center in trying to figure out how you can tokenize securities en masse. And, I think right now it's just a, regulatory issue, but also a kind of how you don't have enough experts, I think, that, in law that understand the limitations of token technology right now. And then and then the people that do understand the technology don't understand the law well enough. So right now there's a shortage of meeting in the minds of both. So you've got a lot of questions, kind of like you mentioned. How do you handle with voting on a blockchain? If you're doing an ERC20 token and you're just having one set of tokens, and how do you do a share repurchase? How do you do a 100% stock acquisition if 10% of the token holders have forgotten their private key? How do you do things like reverse stock splits when all the tokens are out there already? So these are things where there are some like not so great solutions, and then there's some workarounds, but there aren't enough. I found there aren't enough corporate and securities attorneys that understand blockchain well enough to really advise on this, and then the technologists don't understand the laws well enough to build for that. So I think that's one of the major blocks that it'll just take some time.
Yeah, and I think just building on that, I think one of the biggest issues that we're seeing is having a compliant secondary market for security tokens. And if you look at the Coinbase acquisition of Paradex and then yesterday the acquisition of an ATS, it seems very clear that they're going down that path of having a regulated ATS to trade security tokens. And meanwhile, I don't believe FINRA has approved a single one. I think that'll happen within the next 6 months, but I don't think they've approved a single one. So to the extent you're operating as an exchange, you're going to have to get an ATS license, and that actually doesn't exist currently. To the extent you're operating as a bulletin board, as AirSwap is, we're positioning ourselves to be able to trade security tokens as well as utility tokens. The other kind of challenges that I think were brought up during the panel earlier today is having custody solutions for tokens. So there are a lot of rules around having customer accounts where if you need to have a qualified custodian, and that actually doesn't exist in the token world just yet.
Yeah, I mean, I think I tend to agree with what Joel was saying as well. We're trying to operate in a kind of regulated environment. We're trying to operate in an exchange that is going to be above board and it's going to be institutional grade. But it's very, very difficult to do that when there's no clarity on what the rules are that you're supposed to be adhering to. I think it's pretty clear here in the U.S. with the CFTC. If the CFTC is willing to, kind of have oversight over a mass array or a broader portfolio of cryptocurrencies, but when you're operating in multiple different jurisdictions and you're precluded from allowing folks to enter a marketplace, you're precluded from allowing, folks who reside in certain jurisdictions to enter a marketplace, it's very, very difficult to create a global marketplace. And that's one of the things that we wrestle with on a day-to-day basis is, kind of what are those points of access and how do you ensure equal access, which is one of the core principles of the CFTC, for these markets. So clarity, I think, from a regulatory standpoint, would probably make our job a lot easier, and then also the user's job is a lot easier because the users are agreeing to terms of service. They probably haven't read what those terms of service are.
No one does, to be honest.
And my suspicion is that the far majority of people probably, are conflicted from, ticking that checkbox and actually, buying and selling cryptocurrencies.
Right. Turning to a sort of lighter note, what are you most excited for in the space looking forward? Yes, there's some regulatory issues to clear, but in the long term, with the technology can achieve, what are you most excited about? I'm thinking, say, we had Block Collider earlier with chain interoperability, so I'm thinking asset interoperability. One day, my stocks will be able to interact with my bonds and my home equity. I'm not sure how it will happen, I just know it's possible. So what are you most excited for?
I'll start. I think that, we're figuring things out, but I'm really excited when, people do figure these things out. The cost of everything is going to drop. The ease of which everything is done is going to drop. More people around the world are going to have access to opportunities they never had before. They're going to have more liquidity. The markets will be more efficient and a little bit better. And that's already happening right now. If you look at like what Harvard is doing, if you look at Securitized, if you look at Polymath, if you look at all the exchanges, people are building these technologies so that like, today, if you're trying to tokenize and you want to do it with like a good team and everything, it takes many months, lots of money. But these companies are coming out with technologies where you won't need a developer and you just can find a lawyer that knows what they're doing. And within 30 minutes, you can create a tokenized offering, on a back burner. That's amazing. Like you haven't been able to really do that before. These days. And I think in the next few years, you'll start seeing companies, big and small, be able to take advantage of that efficiency in the marketplace.
Yeah, we're looking forward to kind of offering fair and global access to all market participants. I mean, that's really kind of one of our core principles, right? As it sits right now, talking to what, Carlos was mentioning before, our aspiration is to have regional benchmarks alongside global benchmarks listed in one place. And what that really ends up doing is it allows customers who want to trade multiple different commodities, multiple different asset classes in one place, the ability to do so. And that unlocks a lot of different benefits, right? One of the benefits is, margin efficiencies. Rather than posting margin on multiple different venues, you can post margin and recognize the benefits of like commodities and like contracts. That's something we really are looking forward to. We can't wait for markets to become global. I mean, really, truly global. If you look at the curve of liquidity around the globe, you see, nothing but, kind of ups and downs depending upon when people are awake and when they're not. We really would love the fact, to have a fully global marketplace where, the pools of liquidity are merged, and ultimately you have, one steep place where anyone can trade any asset class, in a global way. So I think that there's a whole bunch of things that we're looking forward to, but those are certainly two of the highlights.
Yeah, and the other thing kind of think about is that you think about traditional asset classes and they start from Wall Street and they eventually go down to Main Street. But in this case, you have an asset class that started in Main Street and is now finally getting to Wall Street. So you see Goldman Sachs opening up a bank. You see Susquehanna Investment Group being public about the group that they have and opening that up to more. So you're seeing all these institutional players getting into the space. And this is giving a lot of credibility to, what we're building ultimately. And I think that those type of players coming in, they're going to decrease arbitrage opportunities and which basically increases price efficiency across markets. They're going to institutionalize a lot of the trading platforms. You'll see probably E-Trade and Fidelity, maybe not E-Trade just yet, but I think Fidelity is a strong supporter of crypto. You probably see them having a retail offering. So just getting into these older institutions that have been around for a long time and have been kind of just sort of scratching the surface, actually seeing them, getting into the space in a meaningful way, I think is going to be positive for the space.
Right. Well, I say let's open up the floor to any questions. So, anyone? Well, in that case, unless anyone has something else to add, I say we should wrap up. Oh, there is a question. Sorry, I couldn't see you from here.
It's on the last point, but maybe talking about how it came from Main Street. Hearing a few different panels today, I'm wondering how Main Street stays involved at an early level. Do no KYC, ICOs, get into things now as a U.S. unaccredited investor, that's extremely difficult. So I'm wondering if kind of Main Street's getting shut out, or how do you think the best way, I guess, looking is to keep, everyday investors participating in the token economy?
So, to people who are watching the live stream webcast, the question is essentially how do retail investors, normal mom and pop shops, and everyone in between get involved in the token economy without being restricted by, being shut out by VCs or anyone who just crowds them out? Jor?
Well, it's not, I say this carefully because, really the laws are, the financial institutions that, Wall Street, helps lobby the laws, but it's not technically Wall Street that doesn't allow Main Street in. It's really the laws that don't allow it, right? Even if Wall Street didn't come in, and if none of the big banks were in the space, the SEC still would be clamping down on regulations that effectively mean that the Main Street investor doesn't really get access to these deals. So I think to deal with kind of what you're talking about, it's really something that starts from the regulatory side. And then, before you can really kind of open it up to everyone, I do think that there has to be some fundamental culture and educational shift in society where I think people think it's okay if regular investors can invest and can bear the risk of making losses in investments as well. Right now, honestly, if you open up this entire industry and you suddenly get a whole bunch of people that lose money, it probably will kill the industry. But if that wouldn't be the case if we had all grown up and all taken financial literacy classes, and we were taught that when you lose money you don't go sue someone, you just say whoops, I made a bad choice. But we're not there yet, so I wouldn't blame Wall Street for that necessarily.
Yes, that's right. You're just.
Well, we're providing software that allows people to connect and find each other, communicate prices and trade ultimately. So if Goldman came in and acquired us, I don't necessarily think that would be bad for the ecosystem. I don't think that they would, they might have different standards, but I don't think, ultimately what that would allow for is allow more people to connect because Goldman has bigger distribution than we do currently.
Yeah, I think that, from our standpoint, we're not, building a business to be acquired, and I don't think anyone really is. I don't think that's why you get involved in building a business. But from a practical standpoint, if our technology, which we believe is very, very sound, can do what we believe it can do, and we can get broader distribution and broader customer protections that are in the marketplace, well, as a future user of what I want to build, I think we'd be all for it.
All right. Any other questions that I can't see? I'm sorry, it's just this thing's in the way. Well, in that case, I say we wrap up here, and welcome back Peter for his closing remarks.
All right, thank you everyone for coming. It's been great having you all. Hope you had fun. I hope you learned some interesting things, met some interesting people. Please get home safe. And to those who want to stick around, we're going to be having some drinks in the area. So enjoy.
Take care.